market recap. I'm Daniel.
And I'm Mira.
Imagine waking up to find that the energy powering your country and, the microchips powering your future both got completely squeezed on the exact same morning.
Yeah, that's not exactly a great way to start the day.
No, not at all. But today, that wasn't a hypothetical. It was the reality of the July 7th, 2026 market session. Welcome to the deep dive. Today, we're analyzing a pretty brutal collision of two major macro forces.
Right. On one side, you have the severe energy shock escalating in the Middle East.
And on the other side?
On the other side, we had a synchronized global warning regarding an AI valuation bubble. It was one of those trading sessions that just aggressively stress tests every single assumption baked into your portfolio.
It really was just a sea of red.
Exactly. Let's just quickly summarize the damage from today, Tuesday, July 7th, 2026. U.S. equities saw severe intraday selling.
Oh, yeah, it was heavy.
The Nasdaq 100 futures took a massive hit. They tumbled over 760 points from their high to close at 29,418.25.
Wow.
And the S&P 500 settled lower at 7,503.85. Volatility spiked, with the VIX crossing 16, and Treasury yields marched painfully higher. The 10-year hit 4.529%.
Which is a huge move for the 10-year. But oil is what really caught my eye.
Right. WTI crude oil spiked a massive 5.3% to $72.21 a barrel.
It's a lot to process for anyone watching the boards today. But before we get into the weeds, just a quick reminder. This deep dive is strictly for market context and discussion only.
Yeah, we're here to break down the mechanics of the market, not to provide personal investment advice or recommendations.
Exactly. Always apply this knowledge to your own unique financial situation.
Okay, let's jump right into session one. What set the stage before the U.S. session? What was the baseline before the opening bell even rang today? Because markets don't operate in a vacuum.
No, they definitely don't. We carried over a lot of baggage from the extended holiday weekend and, Monday's data on July 6th.
Right.
The market had been attempting this incredibly delicate high wire act. Investors were trying to balance a newly softening U.S. labor market against some very sticky inflation data.
Yeah, everyone's watching that inflation data like a hawk.
Exactly. So on Monday, the ISM Services PMI came out. It printed a solid 54.0.
Which, sounds like good news on the surface. You want the service sector to expand.
You do, but the devil is always in the sub-indices. The prices paid component of that ISM report was stubbornly elevated at 67.7.
67.7.
Yeah. And for context, anything over 50 shows expansion, so 67.7 is practically screaming that service sector inflation is not dead yet. Not by a long shot. And when service providers are paying more for inputs, that cost eventually gets passed down to you, the consumer. It just makes the Fed's job so much harder.
It really does.
And you really can't look at that sticky domestic inflation data without looking at the geopolitical carryover.
Oh, absolutely.
We walked into today with the fragile reopening of the Strait of Hormuz from earlier in the month already looking, frankly, incredibly vulnerable.
Yeah, it was on thin ice.
Right. Over the weekend, Ukraine successfully struck Russia's Omsk oil refinery, which is their largest, by the way.
Right.
And they hit some Shadow Fleet fuel tankers in the Azov Sea earlier in the week. So global energy infrastructure was already in the crosshairs before the sun even came up.
So if you pause and just look at that specific mix, you have sticky domestic service costs colliding with bubbling global energy risks.
It's a toxic combo.
It really is. It set a highly fragile stage for risk assets. Especially those crowded tech trades that absolutely require low yields to justify their massive valuations.
Right. So the market walked into Tuesday already hypersensitive to inflation data and supply chain disruptions. The kindling was all laid out, totally dry. We're going to take a short break, but when we come back, we're going to look at the specific catalysts that basically blew this fragile setup wide open.
Stay with us.
Okay, we're back. Let's move into session two. What moved markets during U.S. trading hours? What exactly drove today's massive intraday swings across equities and commodities?
Well, the spark arrived late Monday evening and accelerated violently into Tuesday. At around 8:42 p.m. Eastern Time on Monday, headlines broke that Iran launched missile and drone strikes targeting commercial shipping directly in the Strait of Hormuz.
Yeah, that was huge. They damaged Qatari and Saudi tankers, right?
Exactly. And the Joint Maritime Information Center immediately raised the threat level to severe.
Which is not a word they use lightly.
No, not at all. And the market impact of that was just immediate. We saw that 5.3% spike in both WTI and Brent crude.
Right, which we touched on earlier. We frequently talk on this show about how falling oil prices act as a consumer tax cut, When it costs less to fill up your gas tank, you have more money to spend on discretionary items.
Yeah, which boosts the broader economy.
Exactly. But today, we saw that dynamic acting in violent reverse. A sudden surge in crude is a harsh consumer tax hike. It just strips discretionary income right away.
And the geopolitical dominoes just kept falling. By 2:46 p.m. Eastern Time today, the U.S. Treasury retaliated. They officially revoked a key Iranian oil-related waiver from June 21st.
Oh, wow. So they just pulled the plug on that.
Yeah, this effectively pulls Iranian barrels right off the global market.
Okay, but I want to challenge the prevailing narrative here for a second, because the media tends to frame geopolitical events like these missile strikes as unpredictable natural disasters, just random chaos.
Sure.
But if we look at this through a game theoretic lens, this isn't random chaos at all, is it?
No, not in the slightest. This is a textbook example of geopolitical escalation as bargaining leverage.
Right. Look at the timing.
Exactly. Iran didn't strike those tankers in a vacuum. They did it precisely when their oil waiver was being heavily scrutinized by the U.S.
It's a calculated squeeze.
They're essentially forcing the global market to price in extreme disruption, showing the West exactly how much pain they can inflict if their oil sales are restricted.
And that squeeze bled immediately into the bond market. Because while this energy shock was unfolding, inflation expectations got a massive, hawkish reality check.
Yeah, they really did. At 11:01 a.m. Eastern Time, the New York Fed's June survey dropped, and it showed public year-ahead inflation expectations surging to 3.7%.
Which is the highest reading we've seen since September 2023.
Right. And that number is basically the Fed's absolute worst nightmare.
Because it's self-fulfilling prophecy, right?
Exactly. If the public expects things to get almost 4% more expensive next year, workers demand 4% higher wages today.
And businesses raise prices to cover those wages.
Right. And suddenly inflation is just entrenched in the psychology of the economy. Which is why it wasn't surprising that Fed President John Williams stepped up earlier at 8:41 a.m. Eastern Time and effectively killed any lingering near-term rate cut hopes.
He was blunt. He basically said the economy is resilient, inflation is still high, and explicit forward guidance right now is just inappropriate.
And the bond market's reaction was swift and brutal. Treasury futures collapsed across the curve. The 10-year yield pushed higher, which drove the U.S. dollar up.
Right, creating what we call a sovereign debt global liquidity vacuum. Capital just rushes out of risky assets and sprints toward the safety of government debt.
Which brings us to the final pillar of today's route, the tech carnage.
Oh, yeah.
Early Tuesday morning at 5:31 a.m. Eastern Time, the Bank of England's Financial Policy Committee issued a stark warning.
What did they say?
They stated that the rapid equity valuations of AI-related companies have left global markets highly vulnerable to a sharp correction. They specifically called out high leverage and crowded positioning.
So the Bank of England basically yells fire in a crowded theater regarding AI valuations, and the Nasdaq just collapses.
Okay, I'm going to push back on that narrative slightly. Did the Bank of England's warning actually crush the Nasdaq today? Or is it simply discount rates acting as valuation gravity?
Explain that for the listeners. How does the gravity work there?
Well, when you buy a high-growth tech company, you're paying for future profits, right? But a dollar earned 10 years from now isn't worth $1 today. You have to discount those future cash flows based on current interest rates.
Right.
So when the 10-year yield surges past 4.5%, the present value of all those future tech profits plummets mathematically. Those crowded AI multiples we're going to have to compress anyway.
So the Bank of England warning just provided a headline excuse.
Exactly. Gravity always wins.
Okay, so to wrap up session 2, an energy supply shock met surging inflation expectations and an official central bank warning on tech valuations. It led to a very nasty risk-off session. We'll take a quick breather and then dive into how individual corporations are actually navigating this storm.
Stick around.
All right, we are back for session 3, corporate events recap and what to watch next. How did the macro narrative actually translate into corporate actions today? Because the news out of big tech was pretty wild.
It really was. The most significant corporate development came from Microsoft at 12:20 p.m. Eastern Time. They announced a massive pivot to in-house AI.
Yeah, I saw that. They're replacing OpenAI and Anthropic models with 7 new proprietary in-house models that they're calling MAI models.
Right, trained completely from scratch.
But wait, Microsoft is the primary financial backer of OpenAI. Why would they suddenly pivot to building everything themselves?
It's all about vertical integration to preserve profit margins. Microsoft is looking at the staggering costs and realizing that if they have to pay a toll to a third party like OpenAI every time a user prompts their software, the long-term math just doesn't work.
Right, which totally validates that narrative of AI CapEx as a physical bottleneck. The infrastructure is so expensive that you have to own the entire stack to protect your margins.
Exactly. And tech sold off heavily on this news, with the sector ETF dropping 2.4%.
And that push for technological independence isn't just happening in the U.S. At 6:32 a.m. Eastern Time, reports emerged that major Chinese AI labs, specifically DeepSeek and Zhipu, are developing their own custom chips.
Yeah, and they're aggressively hiring domestic engineers to completely bypass U.S. export controls.
Which introduces a massive long-term structural risk to Western semiconductor demand.
Absolutely. And to fund all this frantic innovation globally, the capital requirements are just astronomical. Just look at Amazon today at 8:03 a.m. Eastern Time.
Oh, right, the bond sale.
Yeah, they launched a massive $25 billion bond sale. It's rated AA- by Fitch, and it is specifically earmarked to fund capital spending in AI infrastructure.
$25 billion. That is a real-time, high-stakes test of the bond market's appetite for hyperscaler debt, especially when yields are rising.
Right. It takes a terrifying amount of money to build the future.
It really does. You know, honestly, I was looking at the trading board today, just seeing a sea of red after the tech rout and the Bank of England warning. It was so grim, I actually asked Microsoft's new in-house AI model to help cheer me up.
Oh, no. What did it say?
The model paused, processed, and said, look on the bright side, at least your portfolio is down in highly efficient, vertically integrated proprietary code.
That is just brutal.
Right. If that doesn't help you feel better, just go look at your gas tank. With crude oil spiking over 5% today, it's likely the only asset you own that actually had a positive return today.
Well, a little gallows humor never hurts on a volatile day. But looking ahead to what to watch next, tomorrow is Wednesday, July 8th.
What's on the calendar?
Watch for the final May wholesale inventories at 10 a.m. Eastern Time. Then the really critical FOMC meeting minutes at 2 p.m. Eastern Time.
Those minutes are going to be scrutinized heavily.
Oh, absolutely. We also get May consumer credit at 3 p.m. Eastern Time and the U.S. Treasury 10-year note auction, which, as we discussed, will heavily impact that valuation gravity.
That auction is huge.